So welcome one and all. During this panel discussion, you will have an opportunity to ask questions to our panelists. So don't be shy. Please feel free to put your hands up. So can everyone just to test the process, put your hand up? There you go, good, okay, excellent. All hands working, fantastic. Okay, so if you hear anything that's interesting, please feel free to stick your hand in the air like you just don't care. Okay. So next, we're going to talk about, as I said, gold and gold mining. So let's just think about where the gold price is right now. Is it where it should be? Andrew?
Definitionally, yes, because of efficient market theory, of course. I think it's pretty much where it ought to be. We've had a relatively long-term view that the equilibrium price for gold post its dramatic correction from 2011 highs, all things considered, which I'll go into detail, should be around 1250. And it's trading slightly above that, and it's 1250 with an expectation it's working its way gradually higher from the late 2015 lows, which I do think I hope are the lows for this cycle, in an upward range, gently. And at some point, there'll become a conjunction of events that'll take it higher to materially higher. But yes, I think it's about bang on. The recent rally, pretty obvious. We saw the US can't stand pain in the stock market for obvious reasons. China can't stand pain in its economy. And both blinked and have stimulated or stopped tightening. And that's obviously a helpful backdrop for gold.
But with a low interest rate environment and lots of political risk out there, why are people buying more gold, or should they be buying more gold?
Well, some people aren't. We've seen central banks buying for political reasons because there's some quasi-new Cold War emerging. Russian and Chinese would rather diversify their reserves into gold. On the whole, not. People don't buy the political risk. If they did, the stock market wouldn't be 2,800. Vol wouldn't be as low as it is in most asset classes. So the political risk isn't that significant. In fact, risk generally is regarded as rather low. I mean, when we model the gold price, we have three factors. One is the true cost of producing gold with an economic return on it, which underpins the gold price, I'd say, at around 1050, 1150, somewhere in that zone. Secondly, returns on competing assets. Historically, gold's had a very good correlation with real interest rates, various points on the curve, but for sake of argument, the real 10-year bond yield. That's low, but it did go up somewhat. Real interest rates have risen. But actually, in 21st century, the competition in the asset class wars is not. So it is with interest rates, it is with cash, it is with bonds, but it's actually probably more importantly with real estate and equities. And the historic returns from those have been generally good. Most places, I think we've all seen some quite big cracks in equities. We're seeing interesting cracks emerging in real estate. And real estate's probably the principal competitor to gold for individuals' haven assets. And as we see real estate markets get their noses down, particularly rich people's real estate markets in Australia, UK, there are obviously pockets of extreme buoyancy, some in Asia, then I think the threat to gold from other asset classes is gradually diminishing. And when the equity markets turn around, then there will be no competition. And I think that will also, when real asset markets go down, that will wake people up to the very real structural problems in the economies and financial system. So risk will suddenly really turn up in a big way. Vols will go up, most asset price will go down, and gold will go up somewhere between a lot and a lot.
Samson, tell us a little bit about demand for gold in China at the moment, and also your take on where the gold price might be going at the moment.
I have both good news and bad news for China. The good news is starting last December, many Chinese suddenly start very bullish about the gold price. Everyone well, not everyone, but many people start thinking about or actually buying gold starting like in January or February. Actually, like most Chinese people, they think gold is probably one of the most no-brainer to invest because they all know that the Chinese economy has been bad and it's most likely going to heading even further down, at least in the first half this year. So that's a big no to buy, like they don't have enough confidence to buy stocks domestically. And secondly, the Chinese government is still very cautious and do not want capital to flow into the real estate market. So like while the Chinese government is starting to post less tightening policy on the real estate market, but in general, people is still it is still challenging to get their money into the property market. So gold is the obvious choice. It's easy to buy, and it's safe haven. Like they don't buy it for growth, but at least like they hope they can retain their purchasing power. However, last year I was actually forecasting a weaker yuan this year because of the economy of China. However, it looks like the yuan will not depreciate against the dollar this year, not because of free market. Actually, ironically, if you listen to both the Chinese and the US officials say during the trade negotiation, while they didn't spit it out explicitly, it is very obvious that one condition that the US official wants China is do not depreciate yuan against the dollar. I have no idea how much they want yuan to appreciate against the dollar, but whenever there's positive progress between the trade negotiation between the two countries, you notice that yuan appreciates against the dollar. And this is very important. We have to pay attention on the yuan currency rate. Why? Because in the last 2 years, in year 2017, yuan was very strong against the dollar. So that year when the US dollar gold price rose like by 13% that year, for the Chinese gold price, it just rose 3% that year because yuan appreciated by 10% against the dollar in that same year. And then last year, when gold price dropped, yuan dropped against the dollar. So that makes the Chinese gold price fell less compared to the dollar gold price. Less price volatility in gold makes gold a less appealing investment vehicle because there's no volatility. So 2 years in a row, the Chinese always get the shorter end of the stick in terms of gold investment. So initially, I had big expectation that Chinese gold demand in terms of investment may surge because of a weaker yuan, but that becomes less likely right now. However, if we look at the Chinese gold price recently, the Chinese gold premium, that means the Chinese gold price trading at how much above the LBMA gold price, has been increasing lately. Last year, the average Chinese gold premium was like maybe $8 or $9 per ounce. But most recently, the premium has risen to like over $14 per ounce. I'm not sure whether it's the demand remains at high levels or the supply has been quite tight in China, because looking at the trade data, Chinese import much less gold in January. I'm not sure how much gold they import in February, but there is a very good chance that the Chinese gold market is relatively tight right now, so that's why there's a high premium. So to summarize, whether how Chinese demand for gold will turn to for the rest of the year, I'm not too sure. I think investment demand will probably increase, but probably will at a pace much smaller than I initially anticipated. But the largest demand for Chinese gold is from the jewelry sector. And I think at best it will only maintain at similar levels compared to last year, because this year, especially in the first half of this year, the consumption sentiment is quite poor in China.
At the conference possibly last year, we were talking about the use of things like Wechat and these opportunities for people to use their Wechat to actually buy sort of tiny amounts of gold. Yes. What's been the uptake of these of this new sort of platform?
I can't say too much, otherwise I could get into trouble. But all I can say is this Wechat thing that can buy, invest, or actually offer gold as gifts to your friends has been around for maybe 3 or 4 years. It's not that new, but in the last 2 or 3 years, due to obvious reasons, Wechat has to, they cannot promote this function or this investment platform due to obvious reasons. They have to keep this as low profile, low key. But as far as I heard starting this year, the regulation has become less tightened against their platform. So in theory, they can have a relatively, they can do more marketing or promotional stuff on this feature this year. But so far, I don't think it's that popular yet amongst the Wechat users. So in other words, I think it will be increasing in terms of popularity, but it takes time.
How does buying gold on Wechat affect your social score?
Not yet.
Don't know. This actually brings us on to something we were talking about outside, about what can be done to sort of promote more gold buying. And Richard, obviously, you mentioned that Teranga's recently joined the World Gold Council. Do you want to tell us a little bit about what they're doing to promote the buying of gold?
Sure, Leo. So what's happened with the World Gold Council, they've fundamentally shifted from a marketing organization to a market development organization. And so they've focused on key markets, including working with central banks, with working here in China on the role of gold and the role it can play within a portfolio that has led to some changes both in the insurance and the pension fund industry. They're working in India as well, and Russia to remove the VAT, and all of these things are quite helpful because about 70% of gold demand is outside of North America and Europe. And so they've done, I think, a great job in helping to develop those markets that I think will pay dividends over the long term for gold investors and gold companies.
In places like India, where they've been sort of, trying to get rid of cash and get everyone electronic, how does gold fit in that kind of theme towards a kind of cashless, transparent society?
It's funny because India's been the largest or the second largest purchaser of gold for a long time, but there was no real express policy by the government. And so the World Gold Council has been working with the Indian government. The Minister of Finance has just laid out gold's role, and the expectation is that's going to pave the way for gold to play an important role as the economy transitions and to a certain degree moves to more of a cashless society. You can now buy gold with your phone in denominations as low as a rupee.
Well, let's talk a little bit about gold equities and how they've performed. How have they done in 2018, and what do we expect for 2019? And is there a split between the majors and the juniors and different countries around the world? Andrew, as someone who invests into these things,
2018 wasn't exactly a vintage year. There was
what has performed well and what has performed poorly?
I mean, the best performing group were the larger Australian producers, multi-billion Australian producers. Had a sweet spot of rising production profiles, favourable Aussie dollar gold price, but most important, real credibility with both specialist and non-specialist investors as sensible companies that would look after their capital, which they could allocate and let them get on with screwing it up, thereby differentiating themselves from most of the larger, not all, but most of the larger North American companies and juniors all over the world. Gold mining management hasn't really been a fantastic worked example of how to make shareholders rich over the long run.
What are they doing wrong, though, these the people you're criticising?
Where to start? I mean, typically they make poor asset allocation decisions, whether it's buying assets at the top of cycle, selling at the bottom, investing in uneconomic projects at any plausible gold price, forgetting about country risk, managing their balance sheet stupidly, hedging gold at the bottom, unhedging at the top. Is that enough for a start?
Given though that a lot of gold projects are in emerging markets with sort of changing governments possibly, and also there's a fair amount of well, I wouldn't say luck, but there's a you have to be reasonably lucky as a gold explorer, I guess.
But I mean, country risk, to paraphrase Rick Rule, the most dangerous geography he knows is California. We have to take a lot of sedatives to want to do something in South Africa. I'm not alone. Mark Bristow gave a great speech at Mining in Dover in January, explaining exactly why he wouldn't be returning to his homeland with the Barrack billions. Conversely, other jurisdictions which people are very worried about quite often turn out to be quite good, and we've made lots of money in places like Mali, Burkina Faso, and Cote d'Ivoire, and Congo occasionally. So I'm not saying, gold, natural resources, a lot of places we've mined out anything near the surface. And lots of difficult places are underexplored. But these things change over time. I mean, Eritrea, Ethiopia were probably, for most people, no-go zones. I think they're both, and have been for a while, pretty legitimate places for mining companies to hope to make money and get it out. I mean, Nebson took $400 million out of Eritrea. I mean, quite amazing. So, yes, what happened though is that the reason the Australians did so well is that they were the only plausible investable companies for active, significant scale active mining specialists, also for generalists. They weren't owned by North Americans who all piled into them, and then you get the index effect. They had this very virtuous cycle. The result of all that is that they are, without exception, extremely expensively valued. I mean, I think you'll really struggle to make money from buying those shares at these prices. They're extremely well-managed companies, almost without exception. If you go through, Northern Star, Evolution, Saracen, Regis, the poster child of them all, and the founder of that concept, probably. And there's one I've forgotten. Yes, St. Barbara. They're brilliantly managed companies, and people are very confident about that, and they've got a premium.
But what's going to happen next? If you say they're expensive right now, Samson, do you have a view on the Australian mining equities? Would you buy?
I didn't say all Australian mines. I just said the big end of town.
The big end of town.
I don't personally rate Newcrest really as a terribly good company. It's a very big company, very good assets. I don't think it is as well managed as those five by a long chalk.
My personal track record was pretty bad last year. With obvious reasons, partly because I'm more focused on the Canadian names, so I didn't take advantage of how well the Aussie names did last year. And the second lesson I learned last year is, in terms of investing in mining stocks, you either invest in producers with obvious reasons, or you either invest in greenfield exploration stories. Let me tell you one of the best lessons I learned last year. In year 2017, I bought Nova Resources at 69 cents, and I did very well. And then in the same year, I bought another name called Great Bear Resources at 40-something cents. But I sold the stock. I sold Great Bear Resources at the end of year 2017. So I missed the entire run last year, which it went to as high as over like $3.50. The lesson that I learned is buying greenfield exploration, especially before the market knows it, is one of the best way to make money in this sector. Obviously, you have to diversify your risk by buying like a basket of exploration companies. But especially last year when the gold price didn't do well, obviously the share price of producers did not do well as well. But last year, the market was still willing to reward exploration success. That's why even the general market sentiment has not been that good for gold last year. We still saw some names like Great Bear Resources, West Haven Ventures. They all did quite well once they had some like drilling success. So I think this year, in general, I think we will have a better gold price this year and a softer dollar index this year compared to last year. But as Andrew suggests, I'm afraid that even this year, the whole market sentiment for gold equities will be better than last year. But I'm afraid that market attention will still flow into general equities and real estate market. So maybe trying to go big or go home by betting on some early stage exploration stories is one of the best risk to reward way to play this sector.
Richard, as the gold miner sitting on the panel, respond to Andrew's accusation that everyone out there is managing these companies poorly. Well, not everyone.
Sorry. To be very, very clear, I didn't say everybody. I said the big end of town, and we all know who we're talking about.
Exactly.
Certainly, Richard, who I've been a shareholder since before Richard was born, even before Richard got to the company, even before the company was listed. True.
But how much of it is down to management, and how much of the success, for example, of the Australian miners is down to the fact that the Aussie dollar was very low, creating a nice gold price in Aussie dollars? And what's your take on the whole way the equities market has played out?
Yeah, I mean, look, I think the Aussies versus the Canadians have done an exceptional job, and there's a variety of reasons. One is currency, but they've also stuck to their knitting. They've invested in projects in their home country. They've got a skilled workforce. These are not crazy expensive projects. Well, part of the problem that you've seen in North America is these really large projects being built and they're over budget, and then they don't work as they were intended. Whereas in the Aussie market, they've stuck to more basic, simple projects to build and operate that we all know how to do. And so, I think part of it is a capital allocation decision where they didn't move into these crazy large projects that some of the North Americans did that have failed so miserably. It is a part of it. Currency's probably to a certain degree a smaller part than it is just they just haven't taken on the massive projects. There's an element of size in North America where bigger is better. But look, we're just miners. There were companies who had a shareholder base who wanted them to grow and build throughout the cycle. There were people who thought $1,900 was a low, and so there were some investments that were made over that period that in hindsight, I think most boards and management groups wouldn't have made. But I think in North America, we continue to struggle. We've had a lot of very well-regarded companies make big mistakes, and it's been a problem. And for us as a smaller mining company, when the large caps trip and fall, it's hard to get new investors or generalist investors to come into the space because they look and they say, well, if the large caps have a problem building a mine in Canada, why should we think that a company building a mine in South America, Africa, or some other faraway place would have any more success? So, it's been a real problem. I think that what you need is your leaders to lead. So I think the Barrick-Randgold merger with Mark Bristow at the helm is a good thing for North American mining industry. And, so hopefully we will see better allocations of capital and wiser decisions and a better industry as we move forward. I agree with Andrew. We've made a lot of mistakes.
There have been some fantastics. I mean, take Victoria and Alasa. Both have done fantastic jobs. It's not it's just the Australians or a pack that's identified as such. They're fantastic success stories from all sorts of places. In Africa, out of Africa, in North America.
When you're making your capital allocation decisions, though, how much have you got in the back of your mind, the sort of criticism maybe that some fund managers have laid at the front door of some of the mining companies? Are you thinking, well, I don't want that to be me? So do you ever second guess yourself when you're making those decisions?
Well, if I don't, the board does.
I hope so.
Yeah, I mean, I think you make every capital decision, well, you do a lot of work. I used to work at Barrick Gold, and there were times when we made large acquisitions with not a lot of due diligence. Today, I would think for the most part, there's an awful lot of due diligence that is generally done. We certainly do it. As a smaller company, you got to get every decision right. And so you've got to follow a belt and suspenders approach, make sure you got a backup plan. But boy, you're always, making sure you're doing the right thing and not necessarily listening to your shareholders, because sometimes your shareholders can be short-term in their focus, and it may be a shareholder who wants to get out of the stock in 3 months. But I think what you've got to do is set with the board a correct strategy where you allocate capital appropriately, and you are strategic about how you move your business forward, and not try and get into the short-term manifestations of the market and try and be all things to all people.
I think I'm sort of to quote Mark Bristow again, who's probably the patron saint of one of good mining management. I remember him vividly saying, and people criticizing large mining companies' management, he said it's a whole room of fund managers, and when you said gold's a no-brain investment, I was wondering why we run a gold fund. He said the reason these companies are so stupid is because they've got such stupid fund managers telling them what to do. There's a huge element about it. I mean, the hedging strategy was imposed on mining companies substantially by their investors. The disastrous hedge at the bottom strategy hobbled the large companies for the first 10 years on 300% of the gold bull market. Anyway, yeah. Look, we're as human.
Yeah, because there's fund managers telling miners how to mine.
Oh yeah,
it's probably not.
No, there are some very smart fund managers, and unfortunately, there's not one sitting on this panel. But there we are.
Samson, some points. You look like you were going to say something, but do we have any questions for the panel at this stage? If you have a comment or a comment about the gold equities market, please do chip in. If not, well, if you think of one, just pop your hand up. But let's talk about gold. Any gold provinces out there that are getting people excited right now? Where should we be looking for the next wave of opportunities around the world? Andrew.
Well, the one that's getting a lot of attention, we've been there. We backed a company, Wechat, Clark, Morgan down the road from Emerald, called Equigold, which had two of the lowest cost producing operations in Australia, Mount Rawdon and Kirkalocka, and then went to Côte d'Ivoire and had at one point 22,000 square hectares of the Côte d'Ivoire. And found a great mine called Benicro, and they, being sensible, cautious, double, treble, quadruple checked, got political insurance, eventually built a very successful mine called Benicro, and it is part of that wonderful West African zone. Unfortunately, they had periodic civil wars, and it was all slightly tricky, but that is definitely now front and central as a hot place to go and explore, and we've got 10 plays on that, I suppose. But the geography, I think, that's most exciting, and we're in Asia, and we try to find things in our own backyard. We normally brilliantly manage to find them in Australia, but and we have big issues with Indonesia. We have periodically made a lot of money in Philippines, but it's not an easy place. China, similarly. I won't do mining in Thailand, although Kingsgate eventually got some money out of that because the 10 years rubbish. I won't do mining probably in Vietnam. We backed, before Morgan Hart, one of the plays we've got in is Emerald, which used to be Renaissance. We backed that, luckily not at an early stage because we bought it at a third of the current price when Justin Tremaine was still running it. And then Morgan Hart, who's one of the best builder operators around, has slogged his way to actually building the first proper mine in Cambodia. And that's a fantastic geological endowment there. As they'll build this mine, then they've got first mover advantage from the foreign company that came and made it work for Cambodia. And I think that's a fantastic geography. In base metals, slightly off-piece, but probably relevant. You know, we backed this company, Myanmar Metals. It's a Bodan is one of the world's great deposits. It's definitely tier 1. It's in a tier 5 country, and it's trading at about 6% of what it should be at in due course. So those are 2, 3.
And several.
Southeast Asia, well, Southeast Asia, Ivory Coast.
Richard, you must be pleased to hear him, Andrew say the Côte d'Ivoire is a good spot.
Well, that's why we're there.
Why did you go? Why did you go there in the first place?
Mark Bristow said it was the best place in Africa to explore, so that's what I told the board. And it's been proven to be quite successful. We've got early stage projects. What's interesting is when you look at the $10 billion spent on exploration, there's still, most of it's going into South America, about $2.5 billion. Bit surprised at that, given some of the challenges in South America. Canada, Australia continue to get 15% of the exploration dollars, the US a little bit less than that. Africa, other places of the world not seeing as much, but I think from my perspective, I think that's where the opportunity is. I think that you've got to go into these new districts because that's where you get the low-hanging fruit. There are some companies that will continue to be successful in those more well-known gold districts, but it's getting harder, I think. But I think some of these new frontier jurisdictions are where the low-hanging fruit will come from and the biggest opportunities.
Have the Côte d'Ivoire government done something in terms of regulation that is better than some of the other?
Stop killing each other.
That was a start.
Apart from that.
No, 35% of the West African gold belt is actually in Côte d'Ivoire, and it's been underexplored because of the issues that Andrew raises. Whereas, you know, you look across the border in Ghana, it's got 19% of the belt, and hundreds of million ounces have been discovered and mined, and same with, you know, Mali's 19, Burkina's 13. So when you look at how prospective those other countries have been, you know, it's clear that, you know, the rocks are the same in Côte d'Ivoire. It's just because of political reasons it's been underexplored. So logic would suggest that spending a little bit of money should have more success there than other areas that are more well developed.
And then some obvious gold belts which have been off limits. You know, and there have been some absolutely epic mines and mining companies built around Tanzania. Well, funnily enough, the Acacia incident has put a lot of, but I mean, one of our definitely most exciting plays is there, with not Acacia, but with people who know the inside out, fantastic asset. And I'm sure as the fog clears, I mean, we know we've got a mining regime, it's not a friendly mining regime, but we've at least got certainty around it now. The money and exploration come step up back into Tanzania, for instance. So places come and go.
So final sort of discussion point I've got here is M&A. We've had, you know, this Barrick Randgold merger, Newmont as well. I've got in on the act with Goldcorp. What's next? Do we expect a lot more? This is the first of a long wave. Thoughts on that? Samson, do you want to?
I think it really depends on the gold price, how they perform like for the rest of this year. Right now, the sentiment is quite bullish on the gold price, but a failure to maintain beyond the 1350 level is quite concerning to me. And traditionally, gold price is usually like become quite weak during second and third quarters, so I'm not too sure. The strong momentum currently we see in the gold price can maintain through the second and third quarter. It really depends on several how things will turn out for the rest of this year. For example, if the United States and China be able to forge a trade agreement sometime this year, it will be bullish to gold because despite there will be less uncertainties, I think a trade truce will contribute to a softer dollar, which in turn will provide support to metal prices. And then obviously we have to see how Brexit go, how it evolve. But again, like if things turn bad on Brexit, it doesn't necessarily mean we will see a huge surge in gold price, because any nasty things happen to Brexit, it will immediately translate to a much weaker pound and euro, which in turn will transform to a much stronger dollar, which again put a cap on the gold price. So it really depends on how things turn out. But in general, I think there are opportunities out there. I know that Chinese mining companies are quite eager to make some acquisition this year. I think one of the possible options that they are waiting is to see what kind of assets that Barrick, the new Barrick, and the new Newmont will spin out or will sell. So they are like probably busy studying various projects and considering to buy projects that these big mining companies do not want, and then they're willing to pay for cash. So in that sense, if there is a deal, for example, like if the new Barrick is going to sell an asset to a Chinese mining company in a full cash transaction, it will be beneficial to the share price of Barrick, obviously, because they have more cash. But it may not be too well to the share price of the Chinese mining company, because they will probably have to do a capital raising in the domestic market in order to get sufficient capital to do the acquisition. So I think in general, overseas listing gold mining companies will have more investment value compared to the Chinese gold mining peers this year.
I think the point I'd make is the market cap of the gold mining sector is $300 billion. The US stock market is $34 trillion. The global stock market is $100 trillion. It's less than half 1%. It's sitting there, these big swinging, big end of town gold mining companies, $20-30 billion. Well, that's the same as your average San Francisco online flower delivery IPO, or Bitweed, that blockchain distributed Canadian cannabis company. I mean, they're completely irrelevant. It's kind of like a complicated game of sort of corporate and financial penis envy. They just want to be globally relevant in the capital markets. They need to be bigger. Unfortunately, big gold companies are rarely better gold companies, and they're just making the challenge for themselves of getting those ounces ever more difficult. The trouble is getting the ounces. If you're already producing 5 or 6 or 10, the marginal ounce is fantastically difficult. And the only way you can do it is doing what they can't do, which is contra-cyclical M&A rather than pro-cyclical M&A, buying at the bottom, selling at the top. So they're creating huge problems themselves. I'm sure it will filter down, and the medium-sized companies will have opportunities to buy some good assets cheap, which is how a lot of the Aussies made their name. It's actually good M&A. And it will create M&A down the chain as these companies seek to buy. I think there'll be big shuffling around some very good Aussie assets, and it'll work their way down. And thereby, slowly, it will be Christmas for us when it happens, the disparity in valuation between the bigger and the smaller companies will be eventually arbed away. And that, because these companies are finding it so hard to get capital, some have got fantastic assets, fantastic people. I'll take a company like Remelius. It's 300 million market cap. It's a great company. It's got great management. I'm not saying, but benchmarked to a large company, it would be trading at 600, 700, 800. I don't own it, by the way. I wish I did. But that disparity is nuts in the real world, and eventually it'll go.
Richard, any thoughts on M&A? I mean, given that
everybody's talking, like more than at any point, I think in the last 30 years that I've been in the industry. I think they probably, M&A falls into two categories. I think Andrew's right. One of them is relevance. So I think there are a number of boards and management groups that are talking about whether or not, if they're a $3 billion company or a $2 billion company, is $5 billion the next threshold, and should they be merging just to provide some relevance? And I don't know whether that makes sense or not.
Provide some relevance to their investment bankers' fee income. That's the relevance they'll provide.
Well, and the bankers have, it's like Christmas with this deal with Barrick and Randgold at no premium. I think there's a number of transactions with industrial logic where I think you will likely see some transactions this year because the equity markets are closed, and I think that boards and management groups are much more receptive to entering into transactions that make industrial logic. Now let's hope that the shareholders agree with that. But I think that boards and management groups today are much more cognizant of the challenges of this market and looking to create value, and that includes M&A and asset sales. So it could be a very good year in terms of reshaping the industry that would be positive, but transactions are always difficult to consummate.
Well, we look forward to seeing how it goes, how it pans out over the next 12 months, and we'll be back here in spring next year to find out if you were wrong or right. So, and in October as well, so we can judge then. But can I have a round of applause for our gold panel? Thank you very much. Very interesting.